Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Genertech Universal Medical Group Company Limited Annual Report. Genertech Universal Medical Group Company Limited offers a wide range of businesses and services that cater to various needs in the healthcare industry. In its finance business segment, the company provides direct finance leasing, sale and leaseback, accounts receivable factoring, operating leases, and advisory services. In addition to financing services, Genertech's healthcare business segment offers medical and healthcare services, hospital operations, import and export of medical-related goods, equipment lifecycle management, medical digitalization services, and intelligent medical health and elder care. The company also provides specialized services such as medical equipment leasing, medical technology, hospital construction and management, medical consulting, and software development. Genertech's diverse range of services enables it to serve a broad client base, including patients, hospitals, medical equipment suppliers, and other public institutions. With its extensive experience in the industry, dating back to 1984, Genertech has established itself as a prominent player in China's healthcare sector. Genertech Universal Medical Group Company Limited market capitalization of $12 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that Genertech Universal Medical Group Company Limited holds a significant advantage in their industry. Genertech Universal Medical Group Company Limited trades at a lower price-to-earnings ratio of 5 times and a lower price-to-book ratio of 0.5 times relative within the industry. This makes the stock appear attractively priced. However, the broader industry is also trading at low valuation levels, suggesting sector-wide pessimism rather than the company-specific undervaluation. Further evaluation is required to identify if the company worthy of investment, or could it be an extended period of low valuation or a value trap. The leverage on the balance sheet appears elevated, with liabilities of 73% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have increased over the past 5 years, which is normal for a growing company. Asset and equity growth have outpaced liabilities, suggesting balanced and healthy expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The company have a dividend yield of 5.93%. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline can be identified through a thorough analysis of the extracted summaries. Revenue growth is primarily driven by the healthcare business, which has seen an increase of 16.7% in revenue. This sector's contribution to total revenue has also increased significantly, reaching 66.3%. Other key contributors to revenue growth include finance lease income, receivables income from sale and leaseback arrangements, and intelligent medical health and elder care services. In addition, the company has expanded its operations into 24 provinces, increasing its coverage of intelligent elderly care systems to 5,410 institutions, and constructing over 73,000 home-based care beds. These initiatives have contributed significantly to revenue growth, with the healthcare business income increasing by 22.3% compared to the previous year. On the other hand, revenue decline is primarily driven by a decrease in other income and gains, share of profits and losses of associates, government special subsidies, and an increase in cost of medical services. These factors have resulted in a decline in revenue from various segments, including finance, healthcare, and others. The net income of the company experienced a decline of 2.6% from 2024 to 2025, with an additional decrease of 2.3% in 2025. This downward trend is puzzling given the increase in revenue by 7.5%. However, the gross profit decreased by 4.4%, which may be a contributing factor to the decline in net income. The profit margins also underwent changes during this period. The net interest margin increased from 3.16% in 2023 to 3.58% in 2024, but then dropped to 4.34% in 2025. This fluctuation may be due to various factors such as changes in interest rates or the company's investment strategies. The return on equity also experienced a decline from 13.63% in 2023 to 12.37% in 2024, and further decreased to 11.83% in 2025. This decrease suggests that the company may be struggling to maintain its profitability despite the increase in revenue. The reasons behind these changes are complex and multifaceted, but it is clear that the company's financial performance has been impacted by various factors. The company's financial performance indicates a consistent generation of positive operating cash flow. The data provided across various pages shows that the company has been able to generate significant amounts of net operating cash flow and operating cash flow in 2024 and 2025. On page 4, it is reported that the net operating cash flow for 2025 was $321,111,000. Similarly, on page 8, the operating cash flow for 2025 was RMB 5,654,096,000. Furthermore, on page 9, the net cash flows from operating activities were RMB 5,776,332 in 2025. The positive trend is also evident when looking at the data provided on pages 69 and 70, where it is stated that the company has been generating positive operating cash flow for both years. Additionally, on page 76, the operating cash flow for both 2024 and 2025 shows a significant increase in revenue from contracts with customers and other sources. The overall picture suggests that the company's financial performance is strong, with a consistent generation of positive operating cash flow over the past 2 years. The company's debt level has undergone significant changes over the past period. According to various reports, the total debt level decreased by 7.4% from RMB 52,014,954 to RMB 48,227,349. This reduction is evident in multiple instances, including a decrease of 3.9% in non-current liabilities and a decline in total current debt. The company's ability to manage its debt has been demonstrated through these reductions. In addition to the decrease in debt level, interest expenses have also seen a significant drop. Interest expenses have decreased significantly, as mentioned on page 8, and cost of borrowings included in cost of sales has reduced from RMB 1,989,653 to RMB 1,629,955. The company's debt ratio has also decreased from 73.42% to 70.3%, indicating a decrease in interest expenses. These changes suggest that the company is effectively managing its financial obligations and reducing its reliance on borrowed funds. The financial performance of various segments and regions within a company has been analyzed. On the positive side, the finance segment showed impressive results with revenue reaching 5,299,906 RMB and profit before tax standing at 2,500,129 RMB. In the healthcare sector, several areas demonstrated significant growth. The healthcare technology business witnessed a substantial increase in revenue, rising by 32.3% on one page and an even more impressive 75.5% on another. Additionally, the life cycle management of medical equipment segment contributed 921.8 million RMB in revenue, marking a notable improvement from previous years. The specialties business also recorded a remarkable growth, with its revenue increasing by 252.6%. These positive trends suggest that certain areas within the company are thriving and contributing to overall success. On the other hand, the healthcare segment struggled, with revenue ranging between 8,470,355 RMB and 9,639,611 RMB, and profit before tax fluctuating between 526,000 and 9 RMB and 2,318,874 RMB. This inconsistent performance indicates areas that require improvement and attention from management. Overall, the analysis highlights both strengths and weaknesses within the company's various segments and regions. Management is optimistic about the company's outlook, citing several key strategies for growth. One major focus area is expanding operations in Chinese mainland subsidiaries by retaining profits from these regions. This move is expected to drive steady growth in the healthcare business, thanks to proactive responses and improvements made by the company. In addition to regional expansion, management emphasizes the importance of collaboration across different regions and core competency enhancement. This will enable the company to improve its overall performance and stay competitive in the market. Furthermore, the company is streamlining its layout of healthcare technology and specialties businesses to optimize efficiency and effectiveness. Financial prudence is also a key aspect of the company's strategy. Management is actively managing financial liabilities to mitigate liquidity risks and exploring investment opportunities to diversify income sources. This approach will help the company maintain stability while pursuing growth initiatives. Overall, management's outlook suggests a commitment to strategic expansion, operational improvement, and prudent financial management. The company has a history of paying dividends to its shareholders. In the past 2 years, it has distributed a total amount of HK 0.35 cents per share in 2024 and HKD 0.36 per share in 2025. The dividend payments for both years were recognized as distributions during the year, indicating that the company has consistently provided returns to its investors through dividends. That concludes the financial summary for Genentech Universal Medical Group Company Limited. Feel free to comment below, and I will be happy to answer them when possible.